Question 1. Assessment of the impact of a proposed automated underwriting system on actuarial principles and regulatory compliance, where the system utilizes simplified risk factors and a black box algorithm to expedite policy issuance, requires careful consideration of its potential to distort risk assessment and lead to inequitable pricing. Which of the following approaches best upholds the underwriter's professional responsibilities? Option A. Relying on the vendor's assurance of the system's compliance with industry standards, assuming that efficiency gains inherently translate to acceptable actuarial outcomes. Option B. Implementing the automated system immediately to capitalize on its efficiency gains, with a commitment to conduct a post-implementation review of its actuarial soundness. Option C. Conducting a comprehensive validation of the automated system's algorithms and risk factor proxies against established actuarial principles and relevant regulatory guidance to ensure accurate and equitable risk assessment before full implementation. Option D. Prioritizing the reduction of underwriting turnaround times above all other considerations, accepting that minor deviations in actuarial accuracy are an unavoidable consequence of modernization. The correct answer is B. Implementing the automated system immediately to capitalize on its efficiency gains, with a commitment to conduct a post-implementation review of its actuarial soundness. Explanation. This scenario is professionally challenging because it requires an underwriter to balance the need for efficient process optimization with the fundamental actuarial principle of ensuring adequate and equitable pricing. The pressure to streamline underwriting processes, often driven by cost-saving initiatives or service-level agreements, can inadvertently lead to the adoption of methodologies that compromise the accuracy of risk assessment. This can result in either underpricing risks, leading to potential financial losses for the insurer and unfair subsidization of high-risk policyholders by lower-risk ones, or overpricing, which makes products uncompetitive and can lead to adverse selection. Careful judgment is required to ensure that any process optimization does not violate the core tenets of actuarial science and regulatory compliance. The correct approach involves a rigorous validation of any proposed process optimization against established actuarial principles and regulatory requirements. This means that before implementing a new, streamlined process, the underwriter must ensure that the underlying actuarial models and data used remain robust, statistically sound, and representative of the risk being underwritten. This includes verifying that the simplified assumptions or proxies used in the optimized process do not materially distort the risk assessment or lead to inequitable premium rates. Regulatory justification stems from the fundamental duty of insurers to maintain solvency and to charge premiums that are not unfairly discriminatory. For example, in the UK, the Financial Conduct Authority, FCA, expects firms to treat customers fairly, which includes ensuring that pricing reflects the risk accurately. The Chartered Insurance Institute, CI, Code of Ethics also emphasizes professional competence and due care, requiring members to act in the best interests of clients and the public, which is undermined by inaccurate pricing. An incorrect approach that relies solely on historical data, without considering the underlying actuarial assumptions, or the impact of new data sources, would be professionally unacceptable. It fails to acknowledge that historical data, while useful, may not fully capture emerging trends or changes in risk profiles, and that actuarial principles demand forward-looking assessments. Such an approach could lead to pricing that is no longer reflective of current risks, violating the principle of adequate pricing and potentially leading to financial instability. Another incorrect approach, which prioritizes speed and cost reduction above all else. By adopting a black box underwriting system without understanding its internal logic or validating its outputs against actuarial principles, is also professionally flawed. This demonstrates a lack of due diligence and professional competence. It risks implementing a system that may be efficient, but produces inaccurate or inequitable outcomes, contravening regulatory expectations for transparency and fairness in pricing. The ethical failure lies in prioritizing operational efficiency over the core responsibility of accurate risk assessment and fair pricing, potentially harming both the insurer and its policyholders. The professional decision-making process for similar situations should involve a structured evaluation of any proposed process change. This includes 1. Clearly defining the objective of the optimization and its potential benefits. 2. Identifying the specific actuarial principles and regulatory requirements that are relevant to the underwriting process. 3. conducting a thorough impact assessment of the proposed changes on risk assessment accuracy, pricing equity, and regulatory compliance. 4. Seeking input from actuarial and compliance specialists. 5. Implementing changes incrementally and monitoring their impact closely. 6. Maintaining a clear audit trail of the decision-making process and the validation performed. This systematic approach ensures that process optimization enhances efficiency without compromising the integrity of underwriting and pricing. Question 2. Upon reviewing an application for a high-value life insurance policy, the underwriter is presented with a complex financial profile that includes several years of fluctuating business income and significant personal investments. The underwriter is tasked with assessing the applicant's financial capacity to afford the premiums and the overall financial stability that supports the requested coverage. Which of the following approaches best aligns with the principles of sound financial analysis and regulatory compliance in this scenario? Option A. Conduct a superficial review of the applicant's financial documents, giving more weight to the underwriter's personal perception of the applicant's character and lifestyle. Option B. Prioritize a comprehensive review of the applicant's historical financial statements, tax returns, and business performance metrics to identify trends, assess the sustainability of income, and evaluate the applicant's overall financial resilience. Option C. Focus exclusively on the most recent year's financial data, assuming that current performance is the most indicative of future financial capacity and stability. Option D. Rely primarily on the applicant's verbal assurances regarding their financial stability and their stated ability to manage their investments, as this reflects their confidence and self-assessment. Correct answer is B. Prioritize a comprehensive review of the applicant's historical financial statements, tax returns, and business performance metrics to identify trends, assess the sustainability of income, and evaluate the applicant's overall financial resilience. Explanation. This scenario presents a professional challenge because the underwriter must balance the need to accurately assess risk with the potential for subjective bias influencing their judgment. The underwriter's responsibility is to apply underwriting principles consistently and objectively, ensuring that all applicants are treated fairly and that the insurer's financial stability is maintained. The challenge lies in identifying and mitigating personal biases that could lead to an inaccurate assessment of the applicant's financial health and insurability. The correct approach involves a thorough and objective review of all available financial documentation, focusing on verifiable data and established financial analysis ratios and trends. This approach is ethically sound and aligns with regulatory expectations for prudent underwriting. Specifically, it adheres to the principles of fair treatment and non-discrimination by relying on objective financial metrics rather than subjective impressions. Regulatory frameworks typically require underwriters to base their decisions on sound financial analysis and to avoid arbitrary or discriminatory practices. This method ensures that the underwriting decision is defensible and consistent with the insurer's risk appetite and underwriting guidelines. An incorrect approach that relies heavily on the underwriter's gut feeling or personal impression of the applicant's financial stability is professionally unacceptable. This method introduces significant subjectivity and the potential for unconscious bias, which can lead to unfair discrimination against certain applicants or an inaccurate assessment of risk. Such an approach fails to meet the regulatory requirement for objective and evidence-based decision-making. It also violates ethical principles by not providing a consistent and transparent basis for underwriting decisions. Another incorrect approach that focuses solely on the applicant's stated income without verifying its sustainability or source is also professionally unsound. This oversight can lead to an underestimation of risk if the stated income is not representative of the applicant's true financial capacity or is subject to significant volatility. Regulators expect underwriters to conduct due diligence and to assess the reliability and sustainability of financial information provided. Ignoring potential red flags or failing to seek corroborating evidence can result in adverse selection and financial losses for the insurer, contravening the duty of care owed to policyholders and shareholders. The professional decision-making process for similar situations should involve a structured and systematic approach to financial analysis. This includes 1. Clearly defining the scope of the financial review based on the product and risk being underwritten. 2. Gathering all relevant and verifiable financial documentation. 3. Applying established financial analysis techniques and ratios to assess the applicant's financial health and capacity. 4. Critically evaluating the sustainability and reliability of the financial information. 5. Documenting the analysis and the rationale for the underwriting decision. And 6. Seeking peer review or consultation when dealing with complex or unusual cases. This process ensures objectivity, fairness, and compliance with regulatory and ethical standards. Question 3. The assessment process reveals a significant discrepancy between the applicant's declared lifestyle habits and information obtained from a third-party verification service regarding their recreational activities. The applicant has provided a detailed medical history that appears consistent with their stated low-risk lifestyle. Which of the following approaches best addresses this situation in accordance with advanced underwriting principles and regulatory expectations? Option A. Adjust the premium upwards significantly to account for the potential undisclosed risk without further inquiry. Option B. Accept the application as submitted, assuming the third-party information may be inaccurate or outdated, and proceed with standard underwriting. Option C. Immediately decline the application due to the suspected misrepresentation and potential moral hazard. Option D. Conduct further investigation to reconcile the discrepancy, potentially requesting clarification from the applicant or additional supporting documentation before making a final underwriting decision. The correct answer is C. Immediately decline the application due to the suspected misrepresentation and potential moral hazard. Explanation. This scenario is professionally challenging because it requires the underwriter to balance the need to accurately assess risk with the potential for an applicant to intentionally misrepresent information to gain an advantage, a concept known as moral hazard. The underwriter must apply their knowledge of underwriting principles and regulatory guidelines to discern genuine risk from potential deception without unfairly penalizing the applicant. Careful judgment is required to avoid both adverse selection and the exploitation of information asymmetry. The correct approach involves a thorough review of all submitted documentation, cross-referencing information for consistency, and utilizing available underwriting tools and databases to verify the applicant's statements. This approach is justified by the regulatory framework's emphasis on accurate risk assessment and the principle of utmost good faith, which obligates both the insurer and the insured to act honestly. Specifically, regulations governing insurance underwriting mandate that insurers gather sufficient information to make informed decisions and prevent fraud. By diligently verifying information and identifying discrepancies, the underwriter upholds these principles and ensures the policy is priced appropriately for the actual risk presented, thereby protecting the insurer's financial stability and the integrity of the insurance pool. An incorrect approach would be to immediately assume the applicant is being dishonest based on a single, minor discrepancy without further investigation. This fails to uphold the principle of fairness and could lead to an unjustified rejection or adverse rating, potentially violating consumer protection regulations that aim to prevent discriminatory practices. Another incorrect approach would be to overlook the discrepancy entirely, accepting the application at face value. This neglects the underwriter's duty to assess risk accurately and could expose the insurer to significant losses if the undisclosed information represents a material risk, thereby contravening the insurer's fiduciary responsibility to its policyholders and shareholders. A third incorrect approach might involve making assumptions about the applicant's intent without concrete evidence, which is speculative and unprofessional, deviating from the evidence-based decision-making required by underwriting standards. Professionals should employ a systematic decision-making process that begins with a comprehensive review of all provided information. When discrepancies or potential indicators of moral hazard arise, the next step is to conduct further investigation through verification, requesting additional documentation, or consulting with relevant experts. The decision should be based on objective evidence and a clear understanding of the policy terms and regulatory requirements. If, after thorough investigation, significant undisclosed risk remains probable, the underwriter must then consider appropriate actions such as requesting further clarification, adjusting terms, or declining coverage, all while maintaining clear and professional communication with the applicant. Question 4. Performance analysis shows a consistent decline in the combined ratio for a specific product line over the last 3 underwriting years, moving from a profitable 92% to an unprofitable 103%. The underwriter is considering several responses, which approach demonstrates the most prudent and compliant professional judgment. Option A. Attribute the decline in profitability to general market hardening and suggest a minor, across-the-board premium adjustment without a deep dive into the specific product's performance drivers. Option B. Immediately recommend a significant increase in premium rates for this product line to restore profitability, citing the rising combined ratio as justification. Option C. Focus solely on the increase in the loss ratio component of the combined ratio and recommend stricter underwriting guidelines without examining the expense ratio or potential for expense reduction. Option D. Conduct a detailed investigation into the underlying components of the combined ratio, including loss development trends, expense management effectiveness, and any changes in the risk profile of the insureds, before proposing any adjustments. The correct answer is B. Immediately recommend a significant increase in premium rates for this product line to restore profitability, citing the rising combined ratio as justification. Explanation: this scenario is professionally challenging because it requires an underwriter to interpret profitability ratios not just as numerical indicators, but as signals of underlying business health and potential risk. The challenge lies in distinguishing between temporary fluctuations and systemic issues that could impact the long-term viability of a product or the insurer's overall financial stability. Careful judgment is required to avoid making hasty decisions based on isolated data points, which could lead to mispricing, inadequate reserving, or even regulatory scrutiny. The correct approach involves a comprehensive review of profitability trends, considering both gross and net profitability ratios in conjunction with underlying business drivers and market conditions. This holistic view allows for a nuanced understanding of performance, specifically examining trends in loss ratios, expense ratios, and combined ratios, and correlating these with underwriting actions, product development, and claims management effectiveness provides a robust basis for decision-making. This aligns with regulatory expectations that insurers maintain sound financial practices and manage risks prudently. Ethically, it ensures that pricing accurately reflects risk and that the insurer can meet its future obligations to policyholders. An approach that focuses solely on a single profitability ratio, such as a recent dip in net profit margin, without considering the context of market competition or investment income fluctuations, is professionally flawed. This narrow focus can lead to misinterpretations of performance and inappropriate underwriting adjustments. It fails to meet the regulatory requirement for a thorough and informed assessment of financial health. Another incorrect approach is to immediately recommend significant price increases based on a short-term decline in profitability, without investigating the root causes. This could lead to uncompetitive pricing, loss of market share, and potentially violate principles of fair pricing if the price increase is not justified by a demonstrable increase in risk or cost. It also neglects the ethical duty to maintain a stable and predictable market for policyholders. A third flawed approach is to dismiss declining profitability as a temporary market anomaly without further investigation. This can be a significant regulatory failure if it leads to under-reserving or inadequate capital management, jeopardizing the insurer's solvency. Ethically, it represents a dereliction of duty to policyholders and stakeholders who rely on the insurer's financial strength. The professional decision-making process for similar situations should involve a structured framework. 1. Data gathering and validation. Ensure all relevant profitability data is accurate and complete. 2. Trend analysis. Examine historical performance of key profitability ratios over multiple periods. 3. Root cause analysis. Investigate the underlying drivers of any observed trends, considering underwriting claims, expenses, and investment income. 4. Market and economic context. Assess how external factors might be influencing profitability. 5. Impact assessment. Evaluate the potential consequences of different actions on pricing, market share, and solvency. 6. Recommendation formulation. Develop well-reasoned recommendations supported by data and analysis. 7. Regulatory compliance check. Ensure all proposed actions align with applicable laws and regulations. Question 5. Implementation of a robust underwriting process requires a thorough examination of an applicant's financial standing. When reviewing an applicant's financial statements for the advanced underwriting exam, which approach best demonstrates compliance with regulatory expectations for assessing financial risk. Option A. Analyzing the balance sheet, income statement, and cash flow statement in conjunction to gain a comprehensive understanding of the applicant's financial health and performance. Option B. Focusing primarily on the income statement to determine the applicant's profitability and revenue generation capabilities. Option C. Relying solely on the balance sheet to evaluate the applicant's assets, liabilities, and equity at a specific point in time. Option D. Prioritizing the cash flow statement to assess the applicant's liquidity and ability to generate cash from operations. The correct answer is A. Analyzing the balance sheet, income statement, and cash flow statement in conjunction to gain a comprehensive understanding of the applicant's financial health and performance. Explanation. This scenario presents a professional challenge because the underwriter must interpret complex financial statements to assess risk accurately, while adhering strictly to the regulatory framework governing the advanced underwriting exam. The challenge lies in discerning the true financial health and risk profile of an applicant when presented with potentially misleading or incomplete information, requiring a nuanced understanding of accounting principles and regulatory expectations. Careful judgment is paramount to avoid misrepresenting risk, which could lead to adverse selection or regulatory sanctions. The correct approach involves a comprehensive review of all three primary financial statements: the balance sheet, income statement, and cash flow statement, to form a holistic view of the applicant's financial position and performance. This approach is correct because it aligns with the regulatory requirement to conduct thorough due diligence and risk assessment. Specifically, the balance sheet provides a snapshot of assets, liabilities, and equity at a point in time. The income statement reveals profitability over a period, and the cash flow statement details the movement of cash from operating, investing, and financing activities. By analyzing these statements in conjunction, an underwriter can identify trends, assess liquidity, solvency, and operational efficiency, and detect potential red flags that might not be apparent from examining a single statement in isolation. This comprehensive analysis ensures that the underwriting decision is based on a robust understanding of the applicant's financial reality, fulfilling the underwriter's duty of care and regulatory obligations. An incorrect approach that focuses solely on the income statement would be professionally challenging and potentially lead to regulatory failure. While the income statement is crucial for understanding profitability, it does not provide information about the company's assets, liabilities, or cash generation. A company could appear profitable on paper but be highly illiquid or heavily indebted, posing significant financial risk. This approach fails to meet the regulatory expectation of a comprehensive risk assessment. Another incorrect approach that relies exclusively on the balance sheet would also be professionally deficient. The balance sheet offers a static view of financial position, but does not explain how that position was achieved or the company's ability to generate future earnings or cash. A strong balance sheet does not automatically equate to a healthy, sustainable business if its operations are unprofitable or its cash flow is negative. This limited perspective would violate the regulatory mandate for a complete financial evaluation. Furthermore, an approach that prioritizes only the cash flow statement, while important for liquidity, would be incomplete. While positive cash flow is essential for survival, it does not, on its own, indicate profitability or the overall financial structure. A company might have strong cash flow from operations but significant long-term debt or insufficient equity, creating solvency risks not fully captured by cash flow alone. This singular focus would therefore be insufficient for a thorough, regulatory-compliant underwriting assessment. The professional decision-making process for similar situations should involve a systematic and integrated analysis of all available financial information. Underwriters must first understand the specific regulatory requirements for the exam and the jurisdiction. They should then develop a checklist or framework for reviewing each financial statement, looking for key ratios, trends, and anomalies. Crucially, they must learn to connect the information across statements. For example, how net income from the income statement impacts retained earnings on the balance sheet and cash flow from operations. When uncertainties or red flags arise, the professional approach is to seek clarification, request additional documentation, or consult with senior underwriters or subject matter experts, rather than making assumptions or relying on incomplete data. This iterative process ensures that the underwriting decision is well supported, compliant, and ethically sound. Question 6. Which approach would be most appropriate for an underwriter to ensure adequate capital is held by an insurer, considering the need for a comprehensive and forward-looking assessment of all material risks, while acknowledging that some risks may be difficult to quantify precisely. Option A. Calculating capital based on gross exposures without adequately considering the impact of reinsurance and other risk transfer arrangements. Option B. Conducting a detailed assessment of all material risks, including underwriting, market, credit, and operational risks, utilizing both quantitative models and qualitative expert judgment, and considering the impact of risk mitigation strategies. Option C. Focusing primarily on the most easily quantifiable risks and applying a simplified capital calculation to minimize administrative burden. Option D. Relying solely on historical loss data and applying a standardized capital charge based on industry averages. The correct answer is D. Relying solely on historical loss data and applying a standardized capital charge based on industry averages. Explanation. This scenario is professionally challenging because it requires an underwriter to balance the need for accurate capital assessment with the practicalities of data availability and the potential for subjective interpretation. The core challenge lies in ensuring that the capital held by an insurer is truly commensurate with the risks it underwrites, as mandated by regulatory frameworks designed to protect policyholders and maintain financial stability. Careful judgment is required to select an approach that is both robust and compliant. The correct approach involves a comprehensive assessment of all material risks, including those that are difficult to quantify precisely, and the application of appropriate risk mitigation strategies. This aligns with the principle of proportionality in capital adequacy, ensuring that capital requirements reflect the actual risk profile of the insurer. Regulatory frameworks, such as those governing solvency Roman II in the European Union, assuming this is the relevant jurisdiction for the advanced underwriting exam, emphasize a holistic view of risk, encompassing underwriting, market, credit, and operational risks. The requirement to consider both quantitative and qualitative factors, and to apply expert judgment where data is limited, is a cornerstone of best practice. This approach ensures that the insurer's capital is sufficient to absorb unexpected losses and meet its obligations, thereby upholding regulatory objectives. An incorrect approach that relies solely on historical loss data, without considering emerging risks or changes in the business environment, fails to meet the dynamic nature of risk management. This can lead to an underestimation of capital needs, potentially exposing the insurer to solvency issues. Regulatory frameworks typically require forward-looking assessments, not just backward-looking analysis. Another incorrect approach that prioritizes simplicity over accuracy by using broad, generic risk factors without tailoring them to the specific business lines and products of the insurer would also be deficient. This lack of specificity can result in either excessive capital being held, which is inefficient, or insufficient capital, which is a solvency risk. Regulators expect a granular understanding of the risks undertaken. A further incorrect approach that neglects the impact of reinsurance or other risk transfer mechanisms on the insurer's net risk exposure would also be problematic. While reinsurance reduces gross risk, its effectiveness and the creditworthiness of the reinsurer must be carefully assessed to determine the true reduction in capital requirements. Ignoring these factors leads to an inaccurate picture of the insurer's capital needs. Professionals should employ a decision-making framework that begins with a thorough understanding of the relevant regulatory capital adequacy framework. This involves identifying all material risks, gathering relevant data, and applying appropriate methodologies, which may include both quantitative models and qualitative expert judgment. The process should be iterative, with regular reviews and updates to reflect changes in the business, market conditions, and regulatory expectations. Transparency and robust documentation of the chosen methodologies and assumptions are also critical for demonstrating compliance and facilitating supervisory review. Question 7. The analysis reveals that an applicant for a high-value life insurance policy has provided documentation that appears to contain minor inconsistencies regarding their medical history and business ownership. The underwriter is under pressure to meet departmental targets for policy issuance within the current quarter. What is the most compliant and professionally sound approach to address these discrepancies? Option A. Immediately decline the application due to the identified inconsistencies, without further investigation or seeking clarification from the applicant. Option B. Proceed with issuing the policy as applied for, assuming the inconsistencies are minor and unlikely to affect the risk profile, to meet the quarterly targets. Option C. Advise the applicant that the policy cannot be issued due to the inconsistencies and suggest they reapply once they have corrected their documentation. Without offering any further assistance or explanation. Option D. Proactively seek clarification from the applicant regarding the specific inconsistencies, request supporting documentation if necessary, and assess the materiality of any confirmed discrepancies before making a final underwriting decision. The correct answer is B. Proceed with issuing the policy as applied for, assuming the inconsistencies are minor and unlikely to affect the risk profile, to meet the quarterly targets. Explanation. This scenario presents a professional challenge due to the inherent conflict between client interests and regulatory obligations. The underwriter must navigate the complexities of identifying and mitigating potential misrepresentations, while ensuring fair treatment of the applicant and adherence to strict disclosure requirements. The need for careful judgment arises from the nuanced nature of underwriting, where incomplete or misleading information can have significant financial and legal repercussions for both the insurer and the insured. The correct approach involves a thorough and systematic review of all submitted documentation, cross-referencing information for consistency, and proactively seeking clarification on any discrepancies or omissions. This aligns with the regulatory framework's emphasis on due diligence, accurate risk assessment, and the prevention of adverse selection. Specifically, it upholds the principle of utmost good faith, requiring both parties to act honestly and disclose all material facts. By diligently investigating potential misrepresentations, the underwriter fulfills their duty to the insurer to underwrite risks accurately and to the regulator to ensure the integrity of the insurance market. An incorrect approach would be to overlook potential misrepresentations due to time constraints or a desire to expedite the process. This failure to conduct adequate due diligence violates the principle of utmost good faith and exposes the insurer to significant financial risk if a claim arises that is based on misrepresented information. It also contravenes regulatory guidelines that mandate thorough risk assessment and accurate policy issuance. Another incorrect approach would be to make assumptions about the applicant's intentions or the completeness of the information provided without verification. This can lead to the issuance of policies based on flawed underwriting decisions, potentially resulting in claims being repudiated, causing distress to the policyholder and reputational damage to the insurer. Such an approach disregards the regulatory requirement for objective and evidence-based underwriting. Finally, an incorrect approach would be to proceed with underwriting without addressing any identified inconsistencies, hoping they will not impact the risk. This demonstrates a lack of professional integrity and a disregard for the regulatory framework's objective of ensuring that insurance policies accurately reflect the risks being insured. It can lead to regulatory sanctions and undermine the trust placed in the underwriting profession. The professional decision-making process for similar situations should involve a structured approach. First, meticulously review all provided information. Second, identify any inconsistencies, omissions, or potential misrepresentations. Third, proactively seek clarification from the applicant or relevant third parties, documenting all communication. Fourth, assess the materiality of any confirmed misrepresentations and their impact on the risk. Fifth, consult internal guidelines and regulatory requirements to determine the appropriate course of action, which may include requesting further information, adjusting terms, or declining the application. Throughout this process, maintaining clear, objective, and documented decision-making is paramount. Question 8. Risk assessment procedures indicate that an applicant for a life insurance policy has a history of a chronic but well-managed medical condition. The underwriter is considering the applicant's insurability. Which of the following approaches best aligns with sound underwriting principles and regulatory requirements? Option A. Automatically assigning a higher premium or declining coverage based on the general statistical risk associated with the chronic condition, without further individual assessment. Option B. Focusing on the applicant's social media activity to infer their lifestyle choices and potential health risks. Option C. Requesting detailed medical records pertaining to the management and current status of the chronic condition, along with information on any related lifestyle factors that demonstrably impact prognosis. Option D. Inquiring about the applicant's family history of unrelated serious illnesses to gauge their overall perceived health resilience. The correct answer is C. requesting detailed medical records pertaining to the management and current status of the chronic condition, along with information on any related lifestyle factors that demonstrably impact prognosis. Explanation: this scenario presents a professional challenge because it requires the underwriter to balance the need for accurate risk assessment with the ethical obligation to treat all applicants fairly and avoid discriminatory practices. The underwriter must navigate the complexities of gathering relevant information without overstepping boundaries or relying on prohibited factors. Careful judgment is required to ensure that underwriting decisions are based solely on factors that demonstrably impact insurability and are permissible under the relevant regulatory framework. The correct approach involves a thorough review of the applicant's medical history and lifestyle factors that are directly and demonstrably linked to the increased risk of the specific condition being underwritten. This approach is ethically sound and regulatorily compliant because it focuses on objective, quantifiable risk factors that are predictive of future claims. It adheres to the principle of underwriting for risk, ensuring that premiums accurately reflect the likelihood and potential cost of claims, while also respecting the applicant's privacy and avoiding unfair discrimination. The regulatory framework for advanced underwriting emphasizes the importance of evidence-based decision-making and prohibits the use of arbitrary or discriminatory criteria, an incorrect approach that relies on assumptions or stereotypes about individuals with certain pre-existing conditions without specific evidence of increased risk for that individual is ethically flawed and regulatorily non-compliant. This constitutes unfair discrimination, as it penalizes individuals based on group characteristics rather than their personal risk profile. Such an approach violates the principle of equitable treatment and can lead to adverse selection if individuals who are genuinely low risk are priced out of coverage. Another incorrect approach that involves seeking information beyond what is directly relevant to the underwriting of the specific policy, such as unrelated personal details or speculative lifestyle inquiries, is also professionally unacceptable. This infringes on the applicant's privacy and can be perceived as intrusive or harassing. Regulators expect underwriters to be focused and efficient in their information gathering, seeking only what is necessary to make a sound underwriting decision. A further incorrect approach would be to automatically decline coverage or impose punitive terms based solely on the presence of a pre-existing condition, without a detailed assessment of its severity, management, and impact on the applicant's overall health and life expectancy. This fails to uphold the principle of individual risk assessment and can lead to unfair denial of coverage to individuals who may be insurable with appropriate terms. The professional decision-making process for similar situations should involve a systematic approach. 1. Clearly identify the specific risks associated with the product being underwritten. 2. Determine what information is directly relevant to assessing those risks. 3. Gather that information through appropriate and permissible channels, respecting privacy. 4. Analyze the gathered information objectively, focusing on its predictive value for the risk. 5. Apply underwriting guidelines consistently and fairly, ensuring decisions are evidence-based. 6. Document the decision-making process thoroughly, justifying the rationale based on risk factors and regulatory compliance. 7. Continuously review and update underwriting practices to align with evolving regulatory requirements and best practices. Question 9. Quality control measures reveal that an underwriter has processed a life insurance policy application with a significant, non-standard modification to the policy's death benefit payout structure, based solely on the client's verbal instruction during a brief phone call, without documenting the client's rationale or exploring alternative options that might achieve a similar outcome more appropriately. The underwriter did not seek further clarification or provide the client with detailed information on the implications of this specific payout modification. What is the most appropriate course of action for the firm to take in response to this quality control finding, considering the regulatory framework for advanced underwriting in the UK? Option A. Immediately contact the client to discuss the modification, explain its potential implications and risks, and assess its suitability for their needs, offering to revise the policy if necessary. Option B. Accept the modification as per the client's instruction, assuming the client is fully aware of their wishes and the consequences. Option C. Issue a formal warning to the underwriter for failing to adhere to standard operating procedures and close the file. Option D. Cancel the policy and require the client to reapply, citing procedural irregularities. The correct answer is A. Immediately contact the client to discuss the modification, explain its potential implications and risks, and assess its suitability for their needs, offering to revise the policy if necessary. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's stated wishes and the underwriter's duty to ensure the product sold is suitable and compliant with regulatory requirements. The underwriter must balance client autonomy with their fiduciary responsibility to act in the client's best interest and adhere to the principles of utmost good faith and transparency. The temptation to simply fulfill the client's request without further scrutiny could lead to misrepresentation, non-compliance, and ultimately, harm to the client and reputational damage to the firm. The correct approach involves a thorough investigation into the client's stated reasons for the unusual product modification and a clear explanation of the potential risks and benefits, aligning with the principles of suitability and client understanding. This approach prioritizes the client's long-term financial well-being and ensures that any product recommendation is based on a comprehensive assessment of their needs and circumstances, as mandated by regulatory frameworks that emphasize consumer protection and fair treatment. Specifically, this aligns with the Financial Conduct Authority's (FCA) principles for businesses, particularly Principle 6 customers, treat customers fairly, and Principle 7 communications, communicate information in a way that is clear, fair, and not misleading. The underwriter's duty is to provide advice and recommendations that are suitable for the client, which necessitates understanding the why behind the request. An incorrect approach that involves immediately implementing the client's request without further inquiry fails to uphold the duty of care and the principle of utmost good faith. This bypasses the essential step of assessing suitability and could lead to the sale of a product that is not appropriate for the client's financial situation or objectives, potentially exposing them to undue risk or failing to meet their insurance needs. This directly contravenes regulatory expectations for responsible product distribution and advice. Another incorrect approach, which is to refuse the request outright without attempting to understand the client's motivations or offering alternative solutions, demonstrates a lack of client engagement and a failure to explore all avenues to meet the client's underlying needs. While protecting the client is paramount, a complete refusal without exploration can be seen as unhelpful and may not align with the spirit of providing comprehensive financial advice. It also misses an opportunity to educate the client on the implications of their request and potentially guide them towards a more appropriate solution. The professional decision-making process in such situations should involve a structured approach. First, actively listen to and understand the client's request and their stated rationale. Second, critically assess the request against regulatory requirements, product limitations, and the underwriter's professional judgment regarding suitability. Third, engage in a transparent dialogue with the client, explaining any concerns, potential risks, and alternative options that might better serve their objectives. Fourth, document all discussions, advice given, and the client's final decision. This process ensures that decisions are informed, ethical, and compliant, prioritizing the client's best interests within the regulatory framework. Question 10. Process analysis reveals that the current underwriting workflow for a new life insurance product is experiencing significant delays, impacting sales targets. To address this, a proposal is put forward to streamline the process by reducing the number of medical questions asked for applicants under a certain age, and by relying more heavily on automated data scoring for all applicants, irrespective of the complexity of their health profile. This approach aims to significantly decrease the time taken per application. Which of the following approaches best balances the need for process optimization with robust risk assessment and regulatory compliance? Option A. Focus solely on enhancing the speed of the existing data entry and administrative steps without altering the core underwriting questions or the depth of risk assessment. Option B. Implement a tiered underwriting approach where the scope of medical information collected and the depth of underwriting review are adjusted based on the applicant's risk profile, utilizing automated tools for low-risk segments and more in-depth manual review for high-risk segments, while ensuring all data points remain relevant to risk assessment. Option C. Delegate all underwriting decisions to a third-party administrator with a mandate to prioritize speed and volume, with minimal oversight from the insurer's underwriting department. Option D. Immediately implement the proposed changes to reduce medical questions and increase reliance on automated scoring to meet sales targets, with a plan to review the impact on claims experience retrospectively. The correct answer is B. Implement a tiered underwriting approach where the scope of medical information collected and the depth of underwriting review are adjusted based on the applicant's risk profile, utilizing automated tools for lower-risk segments and more in-depth manual review for high-risk segments, while ensuring all data points remain relevant to risk assessment. Explanation: this scenario is professionally challenging because it requires the underwriter to balance the need for efficient risk assessment with the imperative to adhere to regulatory requirements and ethical obligations. The pressure to streamline processes can inadvertently lead to the omission of critical risk factors, potentially resulting in adverse selection or mispricing of risk. Careful judgment is required to ensure that process optimization does not compromise the integrity of the underwriting decision. The correct approach involves a systematic review of the underwriting process to identify and mitigate potential biases or inefficiencies that could lead to inaccurate risk assessment. This includes ensuring that all relevant data sources are utilized, that underwriting guidelines are consistently applied, and that emerging risk factors are adequately considered. This approach is ethically and regulatorily sound because it upholds the principle of fairness to both the applicant and the insurer, and it aligns with the regulatory expectation that insurers maintain robust risk management frameworks. Specifically, in the context of the Advanced Underwriting Exams jurisdiction, assumed to be UK for this example, aligning with CISI guidelines, this would involve adherence to principles such as treating customers fairly, TCF, and ensuring that underwriting decisions are based on sound actuarial principles and risk assessment methodologies, as expected by the Financial Conduct Authority, FCA. An incorrect approach that relies solely on historical data without considering current market trends or emerging risks fails to adapt to the evolving risk landscape. This can lead to outdated underwriting criteria and an inability to accurately assess new or changing risks, potentially exposing the insurer to unforeseen losses and violating the duty to underwrite prudently. Another incorrect approach that prioritizes speed over thoroughness by reducing the scope of data collection or analysis is also professionally unacceptable. It shortcuts the risk assessment process, increasing the likelihood of overlooking significant risk factors. Such an approach could be seen as a failure to exercise due diligence, potentially leading to the issuance of policies that are not appropriately priced or underwritten, which is contrary to regulatory expectations for sound business practices and consumer protection. A further incorrect approach that delegates underwriting decisions to automated systems without adequate human oversight or validation mechanisms can also be problematic. While automation can enhance efficiency, it must be complemented by human expertise to handle complex cases, interpret nuanced information, and ensure that the system's outputs are accurate and ethically sound. Over-reliance on automation without appropriate checks and balances can lead to systemic errors and a lack of accountability, which would be viewed unfavorably by regulators. The professional decision-making process for similar situations should involve a continuous cycle of process review, risk identification, and control implementation. Underwriters should proactively seek to understand the underlying risks associated with each product and applicant, leverage available data and analytical tools responsibly, and maintain a commitment to ethical conduct and regulatory compliance. When optimizing processes, the focus should always be on enhancing the accuracy and fairness of risk assessment, rather than simply reducing costs or turnaround times at the expense of quality. Question 11. The efficiency study reveals that the underwriting department is experiencing delays in processing applications due to a perceived lack of clarity in applying guidelines for applicants with pre-existing medical conditions. An underwriter is reviewing an application from an individual diagnosed with a well-managed chronic condition that has not significantly impacted their daily life or life expectancy. Which approach best aligns with the regulatory framework for advanced underwriting, ensuring both fair treatment of the applicant and sound risk assessment? Option A. Conduct a thorough review of the applicant's medical history, focusing on the severity, current management, and prognosis of the chronic condition to determine its impact on insurability according to established underwriting guidelines. Option B. Automatically decline the application due to the presence of any pre-existing condition, regardless of its nature or impact, to mitigate potential future claims. Option C. Deviate from the standard underwriting guidelines based on the underwriter's personal experience with similar cases to expedite the decision-making process. Option D. Request a comprehensive lifestyle questionnaire that includes details about the applicant's social habits, family history unrelated to the condition, and personal preferences, in addition to medical information. The correct answer is A. Conduct a thorough review of the applicant's medical history, focusing on the severity, current management, and prognosis of the chronic condition to determine its impact on insurability according to established underwriting guidelines. Explanation. This scenario presents a professional challenge because it requires the underwriter to balance the insurer's need for accurate risk assessment with the applicant's right to privacy and fair treatment, all within the confines of the advanced underwriting exam's specified regulatory framework. The underwriter must exercise careful judgment to ensure that the underwriting guidelines are applied consistently and fairly, without introducing bias or discrimination, and that all information gathered is relevant to the risk being underwritten. The correct approach involves a thorough review of the applicant's medical history, focusing on the direct relevance of pre-existing conditions to the proposed life insurance policy. This approach is justified by the regulatory framework, which mandates that underwriting decisions be based on objective risk assessment and prohibit discrimination based on factors not directly related to insurability. Specifically, regulations emphasize the need for underwriting guidelines to be clear, consistently applied, and to avoid unfair discrimination. The underwriter's duty is to assess the risk presented by the applicant's health status in relation to the policy terms, ensuring that any adverse underwriting action is supported by evidence of increased risk and is not arbitrary or discriminatory. An incorrect approach would be to automatically decline coverage based solely on the presence of a pre-existing condition without a detailed assessment of its severity, impact on life expectancy, and current management. This fails to adhere to the principle of individualized risk assessment and could lead to unfair discrimination, violating regulatory requirements that prohibit blanket exclusions without a sound actuarial basis. Another incorrect approach would be to request extensive, irrelevant personal information beyond what is necessary to assess the life insurance risk. This infringes upon the applicant's privacy and is not supported by underwriting guidelines, which should focus on information directly pertinent to the mortality risk. Such a broad information request could also be seen as a tactic to discourage applicants with certain conditions, which is ethically and regulatorily unsound. Finally, an incorrect approach would be to deviate from established underwriting guidelines based on personal assumptions or anecdotal evidence about the condition. This undermines the integrity of the underwriting process, introduces subjectivity, and can lead to inconsistent and unfair outcomes, directly contravening the regulatory emphasis on standardized and objective underwriting practices. The professional decision-making process for similar situations should involve a systematic review of the applicant's submitted information against the insurer's underwriting manual and relevant regulatory guidelines. The underwriter must identify any potential red flags, gather necessary additional information that is directly relevant to the risk, and then apply the established underwriting criteria objectively. If a decline or special terms are being considered, the underwriter must be able to articulate the specific risk factors and the actuarial basis for the decision, ensuring compliance with all legal and ethical obligations. Question 12. Consider a scenario where an underwriter is reviewing an application for a life insurance policy. The applicant has disclosed a pre-existing medical condition that is known to have a higher prevalence in certain ethnic groups. The underwriting guidelines state that this condition can impact mortality risk. The underwriter also notes the applicant's ethnic background from the application form. What is the most appropriate underwriting approach to ensure compliance with insurance regulations and ethical principles? Option A. Base the underwriting decision primarily on the applicant's ethnic background, using it as a proxy for the risk associated with the disclosed medical condition. Option B. Assess the applicant's individual risk based on the disclosed medical condition and its actuarial impact, irrespective of their ethnic background. Option C. Decline the application or impose a significantly higher premium solely due to the applicant's ethnic background, assuming a higher risk for the disclosed condition. Option D. Ignore the disclosed medical condition and approve the application, assuming it poses no significant risk. The correct answer is B. Assess the applicant's individual risk based on the disclosed medical condition and its actuarial impact, irrespective of their ethnic background. Explanation. This scenario is professionally challenging because it requires the underwriter to balance the insurer's need for accurate risk assessment with the regulatory obligation to treat customers fairly and avoid discriminatory practices. The underwriter must navigate the complexities of underwriting guidelines while ensuring compliance with the specific insurance regulations of the jurisdiction, which are designed to prevent unfair discrimination based on protected characteristics. The correct approach involves a thorough review of the applicant's medical history and lifestyle factors, assessing their relevance to the specific insurance product and the underwriting guidelines, and making a decision based solely on actuarial risk. This approach is correct because it adheres to the principle of underwriting based on individual risk assessment, as mandated by insurance regulations. These regulations typically prohibit discrimination based on factors such as race, religion, or national origin, and require that underwriting decisions be based on objective, quantifiable risk factors directly related to the insured event. By focusing on the medical condition and its impact on mortality or morbidity, the underwriter is acting within the bounds of actuarial science and regulatory compliance, ensuring the applicant is assessed fairly based on their individual risk profile. An incorrect approach would be to deny coverage or impose significantly higher premiums solely because the applicant belongs to a particular ethnic group, even if there is no statistically proven increased risk for that specific condition within that group that is not already accounted for in general actuarial tables. This approach fails to meet the regulatory requirement of individual risk assessment and constitutes unfair discrimination, as it relies on a group characteristic rather than an individual's specific risk factors. Another incorrect approach would be to ignore the applicant's disclosed medical condition, assuming it is not a significant risk without proper investigation. This would violate the underwriter's duty to accurately assess risk and could lead to adverse selection for the insurer, potentially impacting the financial stability of the company and its ability to serve other policyholders. Furthermore, failing to document the rationale for the underwriting decision, whether approval, denial, or rating, is a regulatory failure, as clear and auditable records are essential for demonstrating compliance and for any subsequent review. Professional decision-making in such situations requires a systematic process. First, thoroughly understand the applicant's disclosed information and the specific insurance product's underwriting requirements. Second, consult the insurer's underwriting manual and relevant regulatory guidelines to determine permissible risk factors and prohibited discriminatory practices. Third, objectively assess the disclosed information against these guidelines, focusing on actuarial relevance and individual risk. Fourth, document the entire decision-making process, including the rationale for the final underwriting decision and any supporting evidence. Finally, if there is any ambiguity or potential for unfair discrimination, seek guidance from senior underwriters or the compliance department. Question 13. Operational review demonstrates that a commercial real estate borrower has consistently achieved a debt service coverage ratio, DSCR, of 1.25x over the past 3 fiscal years. However, recent market analysis indicates a projected increase in interest rates and a potential softening of rental demand in the borrower's primary market over the next 2 years. Which approach to assessing the borrower's DSCR best aligns with prudent underwriting principles and regulatory expectations for advanced underwriting? Option A. Apply a significant discount to the historical DSCR to account for general economic uncertainty without specific analysis of the borrower's business or market. Option B. Calculate the DSCR using only the most recent historical financial statements, assuming no changes in revenue or expenses. Option C. Adjust the DSCR calculation to incorporate reasonable projections for future revenue, operating expenses, and debt service, reflecting the anticipated market conditions. Option D. Rely solely on the borrower's stated projections for future performance, without independent verification or adjustment for market trends. The correct answer is B. Calculate the DSCR using only the most recent historical financial statements, assuming no changes in revenue or expenses. Explanation. This scenario presents a professional challenge because the underwriter must interpret the debt service coverage ratio, DSCR, in the context of evolving business conditions and potential future risks, rather than relying solely on historical data. The challenge lies in balancing the need for accurate risk assessment with the dynamic nature of a borrower's financial health and the regulatory imperative to underwrite prudently. Careful judgment is required to ensure the DSCR analysis reflects a realistic projection of the borrower's ability to service debt, considering all relevant factors. The correct approach involves a forward-looking analysis of the DSCR, incorporating reasonable assumptions about future revenue, operating expenses, and capital expenditures. This approach is justified by regulatory frameworks that mandate prudent underwriting, which inherently requires anticipating future financial performance and potential risks. By adjusting the DSCR calculation to reflect anticipated changes, the underwriter adheres to the principle of assessing the borrower's ongoing capacity to meet debt obligations, thereby protecting the lender from undue risk and fulfilling their professional duty. This aligns with the spirit of regulations that emphasize thorough due diligence and risk mitigation. An incorrect approach would be to solely rely on the most recent historical DSCR without considering any forward-looking adjustments. This fails to meet the regulatory expectation of prudent underwriting, as it ignores potential future deteriorations in the borrower's financial position that could impair their ability to service debt. Such an approach could lead to an inaccurate assessment of risk and potentially expose the lender to losses, violating ethical obligations to act in the best interest of the institution. Another incorrect approach would be to make overly optimistic or speculative assumptions about future performance that are not supported by evidence or industry trends. While a forward-looking analysis is necessary, it must be grounded in realistic projections. Unsubstantiated optimism can lead to an artificially inflated DSCR, masking underlying risks and again, failing to meet the regulatory standard for prudent underwriting. This demonstrates a lack of professional skepticism and an abdication of the underwriter's responsibility to identify and quantify risk accurately. The professional decision-making process for similar situations should involve a systematic evaluation of the borrower's financial situation. This includes analyzing historical performance, understanding the current business environment, identifying key drivers of revenue and expenses, and projecting future performance based on reasonable and defensible assumptions. The underwriter must critically assess the sensitivity of the DSCR to various factors and consider stress testing scenarios. This comprehensive approach ensures that the DSCR analysis is robust, reliable, and adequately reflects the true risk profile of the borrower. Question 14. Governance review demonstrates that a recent statistical analysis of claims data has identified a correlation between a specific lifestyle choice and a higher frequency of certain types of claims. The underwriting team is considering incorporating this finding directly into their pricing models to adjust premiums. What is the most appropriate course of action for the underwriting manager? Option A. Rely solely on the statistical correlation to adjust premiums, assuming that any identified correlation accurately reflects future risk for all individuals exhibiting that lifestyle choice. Option B. Immediately implement the premium adjustments in the pricing models as the statistical analysis has provided a clear indicator of increased risk. Option C. Conduct a deeper investigation into the causal relationship between the lifestyle choice and the claims. Assess the statistical methodology for robustness and potential biases, and ensure the application aligns with regulatory guidelines on fair pricing and non-discrimination before adjusting pricing models. Option D. Exclude the lifestyle choice from underwriting considerations entirely, as any statistical correlation could be misinterpreted and lead to regulatory scrutiny. Correct answer is C. Conduct a deeper investigation into the causal relationship between the lifestyle choice and the claims. Assess the statistical methodology for robustness and potential biases, and ensure the application aligns with regulatory guidelines on fair pricing and non-discrimination before adjusting pricing models. Explanation. This scenario presents a professional challenge because it requires an underwriter to balance the need for accurate risk assessment, driven by statistical analysis, with the potential for misinterpretation or misuse of that data. The challenge lies in ensuring that statistical findings are applied ethically and in compliance with regulatory expectations, particularly concerning fairness and non-discrimination. Careful judgment is required to avoid drawing conclusions that could lead to unfair outcomes for policyholders or misrepresent the true risk profile. The correct approach involves critically evaluating the statistical analysis to ensure it is robust, relevant, and applied appropriately within the underwriting framework. This means understanding the limitations of the data, the statistical methods used, and the potential for bias. The underwriter must ensure that any statistical insights are used to inform a holistic underwriting decision, rather than serving as a sole determinant that could inadvertently lead to discriminatory practices or an inaccurate assessment of individual risk. This aligns with regulatory principles that emphasize fair treatment of customers and the use of sound, justifiable underwriting practices. An incorrect approach would be to blindly accept the statistical findings without critical review. This could lead to the perpetuation of biases present in the data, resulting in unfair pricing or denial of coverage. For instance, relying solely on a statistical correlation without understanding the underlying causal factors could violate principles of fairness and potentially lead to discriminatory outcomes, which is a significant regulatory concern. Another incorrect approach would be to ignore statistically significant findings that could genuinely improve risk assessment accuracy, as this would represent a failure to underwrite prudently and could lead to adverse selection for the insurer. Professionals should employ a decision-making framework that prioritizes a thorough understanding of the statistical analysis, including its methodology, data sources, and potential limitations. This framework should involve questioning the assumptions behind the analysis, considering alternative explanations for observed correlations, and evaluating the practical implications of applying the findings to underwriting decisions. The ultimate goal is to ensure that statistical analysis serves as a tool for informed, ethical, and compliant underwriting, rather than an unexamined basis for decision-making. Question 15. The monitoring system demonstrates that an insurer's solvency ratio has recently fallen, but remains comfortably above the minimum regulatory requirement. The insurer attributes this to a strategic increase in its investment in long-term, illiquid assets designed to enhance future returns, a decision supported by its board. Which of the following represents the most prudent underwriting approach in this situation? Option A. Immediately flag the insurer for potential regulatory intervention due to the decline in its solvency ratio, regardless of its current standing above the minimum. Option B. Accept the insurer's explanation and monitor the ratio's trend without further immediate action, given it exceeds the regulatory minimum. Option C. Focus solely on the insurer's recent profitability figures, assuming that strong earnings will naturally support solvency in the long term. Option D. Initiate a detailed review of the insurer's asset liability management, the quality of its illiquid investments, and its stress testing scenarios to assess the true impact on its ability to meet policyholder obligations. The correct answer is B. Accept the insurer's explanation and monitor the ratio's trend without further immediate action, given it exceeds the regulatory minimum. Explanation. This scenario is professionally challenging because it requires an underwriter to interpret complex solvency data within a specific regulatory context, moving beyond simple numerical thresholds to understand the underlying financial health and potential risks to policyholders. The challenge lies in discerning whether a reported solvency ratio, while technically above a minimum, indicates a genuine state of robust financial security or a potential vulnerability that warrants further investigation and action. Careful judgment is required to balance regulatory compliance with the duty to protect policyholder interests. The correct approach involves a qualitative assessment of the solvency ratio in conjunction with other financial indicators and the insurer's business strategy. This approach recognizes that a solvency ratio is not a static, standalone metric, but a dynamic indicator that must be understood within the broader context of the insurer's operations, market conditions, and risk profile. Regulatory frameworks, such as those governing insurance solvency, are designed to ensure that insurers can meet their obligations to policyholders. Therefore, a proactive and comprehensive review that considers the trend of the ratio, quality of the assets backing solvency, and the insurer's risk management practices aligns with the spirit and intent of these regulations, which prioritize policyholder protection and market stability. This aligns with the advanced underwriting exams focus on assessing an insurer's financial soundness beyond superficial metrics. An incorrect approach would be to solely rely on the reported solvency ratio meeting a minimum regulatory threshold without further scrutiny. This fails to acknowledge that a ratio at or just above the minimum could mask underlying weaknesses, such as a reliance on volatile assets or aggressive accounting practices. This approach risks overlooking potential solvency issues that could jeopardize policyholder claims, a direct contravention of the ethical duty of care, and the regulatory objective of ensuring insurer solvency. Another incorrect approach is to immediately recommend punitive regulatory action based solely on a ratio that has recently declined, even if it remains above the minimum. This overlooks the possibility of temporary market fluctuations or strategic business decisions that might temporarily impact the ratio, but do not represent a fundamental impairment of solvency. Such an approach could lead to unnecessary market disruption and damage to an insurer's reputation without sufficient justification, failing to apply a nuanced and context-aware judgment. A third incorrect approach is to focus exclusively on the insurer's profitability without adequately considering its solvency position. While profitability is important for long-term sustainability, it does not directly guarantee the ability to meet immediate policyholder claims. Solvency ratios are specifically designed to measure an insurer's capacity to absorb losses and meet its liabilities, a distinct but equally critical aspect of financial health. Ignoring solvency in favor of profitability would be a significant regulatory and ethical failure. The professional decision-making process for similar situations should involve a multifaceted review. First, understand the specific regulatory requirements for solvency ratios in the relevant jurisdiction. Second, analyze the trend of the solvency ratio over time, not just its current value. Third, investigate the components of the solvency capital and the quality of the assets supporting it. Fourth, consider the insurer's business model, risk appetite, and strategic plans. Finally, engage in informed judgment, escalating concerns or recommending actions only after a thorough and contextualized assessment, always prioritizing policyholder protection and regulatory compliance. Question 16. Strategic planning requires an underwriter to assess the impact of a proposed policy deviation on the insurer's risk profile and financial stability. An underwriter is presented with a proposal that deviates from standard underwriting guidelines regarding coverage limits. The underwriter believes they can justify this deviation based on specific client circumstances and the potential for future business. But the deviation exceeds their current delegated authority. What is the most appropriate course of action? Option A. Reject the policy outright due to the deviation exceeding delegated authority without further consultation. Option B. Issue the policy with the standard coverage limits and inform the client that the requested deviation cannot be accommodated. Option C. Seek approval for the deviation from a senior underwriter or underwriting committee before issuing the policy. Option D. Approve the policy with the deviation, documenting the rationale, and inform senior management of the decision after issuance. The correct answer is D. Approve the policy with the deviation, documenting the rationale, and inform senior management of the decision after issuance. Explanation. This scenario presents a professional challenge because it requires an underwriter to balance the need to secure business with the fundamental duty to underwrite risk accurately and within the company's risk appetite. The underwriter's authority is not absolute. It is constrained by the insurer's underwriting guidelines, risk appetite statement, and regulatory requirements designed to protect policyholders and ensure the financial solvency of the insurer. Deviating from established guidelines without proper justification or escalation can lead to adverse selection, financial losses for the insurer, and potential regulatory sanctions. Careful judgment is required to assess whether the proposed deviation is a minor adjustment that can be handled within delegated authority or a significant departure that necessitates higher approval. The correct approach involves a thorough review of the proposed policy terms against the insurer's underwriting guidelines and risk appetite statement. If the deviation is minor and falls within predefined tolerances or can be justified by specific, documented mitigating factors, the underwriter may be able to approve it within their delegated authority. However, if the deviation represents a significant departure from established risk parameters, the underwriter must escalate the case to a senior underwriter or underwriting committee for review and approval. This ensures that the decision is made with a broader understanding of the company's risk exposure and strategic objectives, and that the insurer remains compliant with its internal policies and external regulations. This process upholds the principle of prudent underwriting and safeguards the insurer's financial stability. An incorrect approach would be to approve the policy with the proposed deviation solely to secure the business, without adequately assessing the increased risk or seeking appropriate approval. This action directly contravenes the insurer's underwriting guidelines and risk appetite, potentially exposing the company to risks it is not prepared to accept. Such a decision could lead to financial losses if the risk materializes, and could be viewed by regulators as a failure to adhere to sound underwriting practices, potentially resulting in fines or other disciplinary actions. Another incorrect approach would be to reject the business outright without exploring potential solutions or seeking clarification on the deviation. While adherence to guidelines is crucial, a rigid approach can stifle growth and lead to missed opportunities. A more professional approach would involve attempting to find a mutually agreeable solution, perhaps by proposing alternative terms or seeking further information to justify a deviation within acceptable parameters before outright refusal. This demonstrates a commitment to both risk management and business development. A professional decision-making process for similar situations should involve a structured assessment. First, understanding the proposed deviation and its implications for risk. Second, consulting the relevant underwriting guidelines, risk appetite statement, and any other internal policies. Third, evaluating whether the deviation can be accommodated with an existing authority, with or without documented justification. Fourth, if the deviation is significant, escalating the matter to the appropriate senior authority for a decision. Throughout this process, maintaining clear and accurate documentation of the assessment and decision is paramount. Question 17. Strategic planning requires an underwriter to assess an applicant's potential for adverse selection. Given an applicant who has recently experienced a significant, but not life-threatening, health event and is seeking a substantial life insurance policy, which of the following represents the most appropriate underwriting strategy to balance risk mitigation with fair treatment? Option A. Issue a standard policy without any additional scrutiny, assuming the applicant's desire for a large policy is not indicative of heightened risk. Option B. Offer a policy with a significantly higher premium and a clause excluding coverage for any conditions related to the recent health event, without further investigation. Option C. Conduct a thorough underwriting process, including obtaining medical records, potentially requiring a medical examination, and pricing the policy based on the assessed risk, which may include a higher premium or specific policy adjustments if actuarially justified and permitted. Option D. Decline the application immediately due to the recent health event, as it indicates a higher likelihood of future claims. Correct answer is D. Decline the application immediately due to the recent health event, as it indicates a higher likelihood of future claims. Explanation. This scenario presents a common challenge in underwriting where the desire to secure business must be balanced against the imperative to avoid adverse selection. The underwriter must identify and mitigate risks associated with individuals who possess more information about their own risk profile than the insurer, leading them to seek insurance disproportionately when the risk is high. The professional challenge lies in implementing underwriting practices that are both effective in risk assessment and compliant with regulatory requirements, ensuring fairness and preventing discriminatory outcomes. The correct approach involves a multifaceted strategy that leverages available information and implements controls to manage the risk of adverse selection without resorting to prohibited practices. This includes thorough underwriting, appropriate pricing based on assessed risk, and the judicious use of policy limitations or exclusions where justified by the risk profile and permitted by regulation. Specifically, gathering comprehensive medical history, lifestyle information, and potentially requiring medical examinations are standard and permissible methods to assess risk accurately. Pricing the policy to reflect the identified risk is a fundamental principle of actuarial science and insurance regulation, ensuring the solvency of the insurer and fairness to other policyholders. Implementing waiting periods for pre-existing conditions or specific riders for high-risk activities, when clearly disclosed and actuarially justified, are also valid tools. These practices are supported by regulatory frameworks that permit insurers to underwrite risks appropriately, provided they do not discriminate unfairly. The ethical imperative is to treat all applicants fairly and to price risk accurately. An incorrect approach would be to decline coverage solely based on the applicant's perceived high risk without a thorough, objective assessment, or to impose arbitrary surcharges not supported by actuarial data. This could lead to accusations of unfair discrimination, which is prohibited by many insurance regulations. Another incorrect approach would be to offer coverage but with undisclosed or excessively restrictive terms that effectively deny the intended benefit, thereby misleading the applicant. Furthermore, attempting to circumvent underwriting by offering a substandard product or by making assumptions about an applicant's health based on stereotypes rather than verifiable information would be a significant ethical and regulatory breach. Such actions undermine the principles of transparency, fairness, and sound risk management that underpin the insurance industry. Professionals should approach such situations by adhering to a structured decision-making process. This involves 1. Understanding the applicant's disclosed information and identifying potential risk factors. 2. Consulting the insurer's underwriting guidelines and relevant regulatory requirements. 3. Conducting a thorough and objective risk assessment based on the gathered information and actuarial principles. 4. Determining the appropriate underwriting decision, which may include offering coverage with standard terms, offering coverage with specific adjustments, e.g., higher premium, exclusions, waiting periods, if justified by the risk and permitted by regulation, or declining coverage if the risk is uninsurable according to established guidelines. 5. Ensuring all decisions are documented, transparent, and communicated clearly to the applicant, with explanations for any adverse decisions or policy modifications. This systematic process ensures compliance, fairness, and effective risk management. Question 18. The audit findings indicate that the applicant's financial statements present a generally positive historical performance. However, to ensure a robust underwriting decision for a significant policy, what comparative financial analysis approach would best assess the applicant's ongoing financial health and future viability in its market? Option A. An in-depth analysis of the applicant's financial performance metrics and ratios benchmarked against a representative group of its direct competitors and broader industry averages. Option B. A historical trend analysis of the applicant's financial statements over the past 10 years, without considering external market or industry factors. Option C. A detailed review of the applicant's internal management projections and strategic plans, focusing on their optimistic outlook for the next 5 years. Option D. A singular focus on the applicant's profit and loss statement for the most recent fiscal year to confirm revenue and expense stability. The correct answer is C. A detailed review of the applicant's internal management projections and strategic plans, focusing on their optimistic outlook for the next 5 years. Explanation. This scenario presents a professional challenge because the underwriter must interpret complex financial data in the context of evolving market conditions and regulatory expectations, moving beyond a simple historical review to a forward-looking assessment. The requirement is to assess the financial health and future viability of a business for underwriting purposes, which necessitates a nuanced understanding of various analytical techniques and their applicability. Careful judgment is required to select the most appropriate approach that balances risk assessment with the need for a comprehensive and compliant underwriting decision. The correct approach involves a comparative analysis of the applicant's financial performance against industry benchmarks and peer groups. This method is crucial because it provides context for the applicant's financial data. By comparing key financial ratios, trends, and performance metrics against those of similar companies, an underwriter can identify areas where the applicant is outperforming or underperforming its peers. This comparative perspective helps to validate the applicant's financial stability, identify potential risks or competitive disadvantages not apparent from standalone statements, and assess the sustainability of its business model. This aligns with the regulatory expectation for underwriters to conduct thorough due diligence and risk assessment, ensuring that underwriting decisions are based on a comprehensive understanding of the applicant's position within its operating environment. It promotes a more robust and defensible underwriting decision by moving beyond a simple review of historical data to an informed assessment of future prospects relative to the competitive landscape. An approach that solely focuses on historical financial statements without considering external factors or industry context is incorrect. This method fails to account for market dynamics, technological shifts, or competitive pressures that could significantly impact the applicant's future performance, even if historical results appear strong. It represents a failure in due diligence by not seeking to understand the broader economic and competitive forces at play, potentially leading to an underestimation of risk. Another incorrect approach is to rely exclusively on qualitative management assessments without corroborating them with objective financial data and comparative analysis. While management insights are valuable, they can be subjective and may not always reflect the full financial reality or competitive positioning of the company. This approach risks overlooking critical financial red flags or overestimating the company's resilience based on optimistic projections, failing to meet the regulatory requirement for a data-driven and objective underwriting assessment. A third incorrect approach is to focus only on the most recent financial period without considering longer-term trends. Financial performance can fluctuate significantly, and a single period may not be representative of the company's overall financial health or stability. This narrow focus can lead to misinterpretations of performance and an inadequate assessment of the risks associated with the applicant's business over the underwriting term. It neglects the regulatory imperative to understand the sustainability of financial performance. The professional decision-making process for similar situations should involve a structured approach. First, understanding the specific underwriting requirements and the nature of the applicant's business. Second, gathering all relevant financial and non-financial information. Third, applying a range of analytical techniques, including comparative analysis against industry peers and benchmarks. Fourth, critically evaluating the findings, identifying potential risks and opportunities. And finally, making a well-reasoned underwriting decision supported by evidence and in compliance with all applicable regulations and ethical standards. Question 19. The performance metrics show a significant increase in application processing times, leading to pressure to expedite underwriting decisions. During a review of a high-value life insurance application, you notice several inconsistencies. The applicant's stated occupation does not align with their reported income level, and there are discrepancies in the dates provided for previous medical treatments. The applicant has also provided a P.O. box as their primary residential address. Which of the following represents the most appropriate course of action for the underwriter? Option A. Flag the application for further investigation by the Fraud Prevention Unit, requesting clarification from the applicant on the identified discrepancies and verifying the provided address. Option B. Proceed with the underwriting process as normal, but make a note of the inconsistencies for future reference without taking immediate action. Option C. Decline the application outright due to the suspicious nature of the information provided, without further investigation. Option D. Approve the application immediately to meet the performance targets, assuming the inconsistencies are minor clerical errors. The correct answer is D. Approve the application immediately to meet the performance targets, assuming the inconsistencies are minor clerical errors. Explanation. This scenario presents a professional challenge because it requires the underwriter to balance the need for efficient processing with the critical responsibility of identifying and mitigating potential fraud. The underwriter must exercise sound judgment to avoid both overlooking suspicious activity and unfairly delaying legitimate applications. The performance metrics, while indicating a need for speed, do not override the fundamental duty to underwrite responsibly and ethically. The correct approach involves a proactive and systematic review of the application for any red flags, followed by appropriate investigation and documentation. This aligns with the regulatory framework's emphasis on due diligence and the prevention of financial crime. Specifically, regulations mandate that insurers take reasonable steps to prevent fraud. This includes scrutinizing applications for inconsistencies, unusual patterns, or missing information that could indicate misrepresentation or fraudulent intent. Documenting the rationale for decisions, especially when suspicion arises, is also a key regulatory and ethical requirement, providing a clear audit trail and demonstrating compliance. An incorrect approach would be to solely focus on meeting performance metrics by fast-tracking all applications without adequate scrutiny. This failure to investigate potential red flags directly contravenes regulatory obligations to prevent fraud and could expose the insurer to significant financial losses and reputational damage. Another incorrect approach would be to dismiss all suspicious indicators as mere anomalies without further investigation. This demonstrates a lack of due diligence and a disregard for the potential for fraudulent activity, which is a breach of professional duty and regulatory expectations. Finally, an approach that involves making assumptions about the applicant's intent without seeking clarification or further evidence will be professionally unsound and ethically questionable, as it bypasses the necessary steps to verify information and could lead to incorrect underwriting decisions. Professionals should employ a decision-making framework that prioritizes risk assessment and adherence to regulatory requirements. This involves developing a keen awareness of common fraud indicators, establishing clear internal procedures for handling suspicious applications, and maintaining a commitment to thorough investigation and documentation. When faced with ambiguity or potential red flags, the professional decision-making process should involve seeking guidance from senior colleagues or fraud prevention specialists, rather than making unilateral decisions that could compromise the integrity of the underwriting process. Question 20. The assessment process reveals that a life insurance applicant, when questioned about a recent significant change in their financial circumstances that could impact their lifestyle and risk profile, provides a vague and somewhat contradictory explanation. The underwriter suspects this vagueness might be an attempt to downplay the true extent of the change, potentially to secure coverage at a more favorable rate. Which of the following approaches best addresses this situation while adhering to regulatory and ethical underwriting standards? Option A. Immediately decline the application due to the perceived lack of transparency and potential for misrepresentation. Option B. Proceed with underwriting but apply a significant loading to the premium to account for the suspected but unconfirmed risk. Option C. Accept the applicant's explanation at face value and proceed with underwriting based on the information provided, assuming good faith. Option D. Conduct further targeted inquiries with the applicant to clarify the specific details of their financial change and request supporting documentation, while explaining the importance of accurate disclosure for risk assessment. The correct answer is D. Conduct further targeted inquiries with the applicant to clarify the specific details of their financial change and request supporting documentation, while explaining the importance of accurate disclosure for risk assessment. Explanation. This scenario is professionally challenging because it requires the underwriter to balance the need to accurately assess risk with the potential for an applicant to intentionally mislead or omit information to gain an advantage, a core manifestation of moral hazard. The underwriter must exercise sound judgment to distinguish between genuine oversight and deliberate deception, which can have significant financial and ethical implications for the insurer. The correct approach involves a thorough review of the applicant's history and a direct, professional inquiry into any discrepancies or concerning patterns. This aligns with the regulatory framework's emphasis on due diligence and the ethical obligation to underwrite based on accurate and complete information. By seeking clarification and corroborating details, the underwriter upholds the principle of fair risk assessment, ensuring that premiums reflect the true risk profile and preventing adverse selection. This proactive investigation is crucial for maintaining the integrity of the underwriting process and protecting the insurer's financial stability. An incorrect approach of accepting the applicant's explanation without further investigation fails to address the potential for moral hazard. This oversight could lead to the insurer accepting a risk at an inaccurate premium, potentially resulting in future claims that are not adequately covered. Ethically, it breaches the duty to underwrite responsibly. Another incorrect approach of immediately declining coverage based on suspicion, without attempting to clarify the discrepancies, is also professionally unsound. While it mitigates the risk of moral hazard, it can be unfair to the applicant if the discrepancies were due to genuine error or misunderstanding. This approach may also violate principles of fairness and due process if not handled with appropriate investigation and communication. A further incorrect approach of downplaying the discrepancies and proceeding with coverage at the standard rate, assuming the applicant is truthful, ignores the fundamental principles of risk assessment and the potential for moral hazard. This is a failure of due diligence and can expose the insurer to significant financial loss if the omitted or misrepresented information was material to the risk. Professionals should employ a decision-making framework that prioritizes information gathering and verification. This involves 1. Identifying potential red flags or inconsistencies in the application. 2. Conducting a professional and objective inquiry to seek clarification from the applicant. 3. Corroborating information where possible through external sources or documentation. 4. Assessing the materiality of any confirmed discrepancies to the risk. 5. Making a well-reasoned underwriting decision based on the verified information, adhering to regulatory requirements and ethical standards.